You need to understand what happened last week. The abrupt crash of the markets with over $8 trillion of market value being wiped out is being regarded as a once-in-a-decade crash that's got a mix of contributing factors. But there's an international angle that's very easy to miss, which is a sudden decision by Japan's central bank to hike interest rates to try and shore up the value of the Japanese yen. So how does that connect all the way to the US stock market? And what can we learn from the clever moves that Warren Buffett made in the weeks prior? I think how Graham Stephan put it in the perfect place to start. Now, of course, this isn't financial advice, but subscribe to the channel and watch this clip before we explore what just happened this past week.
That's right. Japan recently raised their interest rates in response to their currency consistently losing value. And as a result, this caused the yen to strengthen and the dollar to decline. Or put another way, imagine you borrow 1.6 million yen to buy 10,000 US dollars. All of a sudden, the yen increases while the dollar declines. And now when you have to pay back the loan, your $10,000 only gets you 1.4 million yen. So you're $200,000 short, and you have to come up with the money fast. What do? Unfortunately, this is exactly what's just happened. As you could see on July 10th, one US dollar bought you 161 yen. And now because of the rate hike, it only gives you 143 yen, a more than 10% decline from peak. And when you spread that across trillions of dollars invested throughout the United States in potentially leveraged positions, you have quite the storm. Essentially, all of this means that trillions of dollars had to be moved around or sold to pay off loans borrowed in another currency that now requires a lot more money to pay back than what was borrowed. And boom, we have the making for a stock market sell-off.
And here's the thing, those arbitrage opportunities for a long time were surviving on a series of key assumptions that have not looked so sure as of late. The first assumption was the outlier in the global economy that Japan has been for decades as its central bank went very low or even negative interest rates in order to deal with the problem of deflation, as opposed to inflation that the rest of the world deals with. Japan's rising of the interest rate out of nowhere in the first quarter of the year sabotaged those arbitrage profit opportunities, requiring an abrupt call back of the invested profits in the US stock market in order to pay back Japanese loans. And that offers an intriguing picture of how closely tied two national economies can be in the modern world. The second assumption is something we've been hearing for some years now, which is the hype built around artificial intelligence and the revolution it promises in businesses. And while the hype around artificial intelligence is not exactly speculation as something you'd see, for example, in the crypto or NFT market, investors are realizing that the financial fruits of AI lie at the end of a long and bumpy road in the economy. That's because first, AI is going to be a disruptive force rather than creative. Jobs are going to be lost, new technologies will have to be adapted to, and society will need to learn to live with new forms of inequality brought in by the AI revolution. It's only after that happens when AI diffuses and absorbs in the economy and finally starts resulting in growth and well-being in the world of finance, as well as the lives of people. Now, the third assumption that those arbitrage opportunities were built on was the stability and trust in the US economy. As much as investors from around the world may trust American Treasury bonds, and the dollar news in the last few months has not served to shore up that trust further, it was the end of the 50-year US-Saudi petrodollar agreement in June this year, and the uncertainty of whether Saudi Arabia might move to diversify currency options for oil sales, especially after the kingdom officially joined the BRICS alliance earlier this year. With all of that combined, discouraging unemployment numbers set off a fear of a recession, leading to an abrupt sell-off in the stock market.
Last week it was announced that US companies are no longer hiring at the same rate that was initially expected, with the chief economist of ZipRecruiter saying that the labor market's clearly no longer normalizing. Further deterioration could set off a negative cycle of job losses, consumer spending declines, business revenue declines, and more job cuts. As a result of that, the unemployment rate increased to 4.3%, which some say is an indicator that the recession that we feared over the last 2 years is finally coming. Why? Well, in this case, we have what's called the SOM indicator, which measures the unemployment rate relative to where it was a year ago. And since the 1950s, it's correctly predicted just about every recession that we've seen. In this case, if the unemployment rate's 3-month moving average rises half a percentage point from its previous year, a recession is either imminent or already underway.
And it's merely that fear and speculation that was enough to set off a chain reaction and lead to a slowdown of consumer spending, as well as a sudden sell-off in the stock market for those arbitrage investors in order to pay back their loans denominated in the Japanese yen. The number of 4.3 when it comes to the US unemployment is the highest we've seen in the last 3 years. To put that in numbers, that's over 7 million people in the labor market that are not able to find a job, therefore do not have the consumer spending power, which is the engine that drives the economy. That's 7 million people that are not spending money, with businesses not contributing to revenues and profits and are not creating more jobs as an indirect consequence. That strains the supply chains and profit margins of companies, leading to even more job losses, less consumer spending, and so on as it spirals. That's why the SAHM indicator is a considered dependable predictor of a recession, and the fear it triggers with the unemployment numbers becomes easier to understand from the point of the view of the investor. Now, while the stock market has partially started to recover after that abrupt fall, we're not completely out of the fear yet. But of course, no one wants to say that, because causing more fear in the market will only make that more inevitable. We've also seen how possible that is, considering how the fear even carried over to the cryptocurrency market, with Bitcoin losing nearly 11% in market cap in the last week alone. Someone that still came out on top in all of this massive stock market slump was Warren Buffett. Warren's holding company Berkshire Hathaway sold over half of its stake in Apple at the peak of the market.
A few days ago, it was announced that Warren Buffett sold nearly half of his stake in Apple last quarter, raising $84 billion in the process. Not only did he seem to have timed the market perfectly compared to where we are today, but he also trimmed his position in Apple shortly before it was announced that Google violated antitrust laws by paying to have their search the default on Apple products, which made up 36% of their revenue. All of this means that Warren Buffett raised a substantial amount of cash before anything like this occurred, essentially at the peak of the market, which, great move.
And you know what? It's all of this liquid cash that's now available for him to swoop up the most secure and reliable investment class, which is the US Treasury bills. In fact, as of today, Warren Buffett owns more Treasury bills than even the Federal Reserve Bank of the US, with over 3% of the entire T-bill market. A lot of the time in the world of investing, it's about being greedy when others are fearful, and being fearful when others are greedy. That's a sentiment and investment strategy that seems to define Warren Buffett perfectly, eventually compounding his net worth into hundreds of billions over his investing career. But let me know in the comments how you're seeing this sudden change and crash in the market, as well as any preparations you're making for a possible period of recession. In the end, individual prosperity or loss depends on the decisions that you make on an individual level, and that's why it's so important to closely follow what's happening and make sure that you make the right moves to safeguard your own financial future.